Today, we're going to go a little bit deeper on the AI topic. It's ever present, ever growing, maybe even a bubble.
You do want to invest early. You want to invest without fees, and you need to diversify because you have no idea what company is going to pop and what company won't.
The dosage makes the poison. It's very true in investing. You never want to be overly concentrated because it can really damage your 100-year family.
In this case, it's an 800% markup. Ideally, you invest before the markup happens. In Anthropic's case, you invest as early as you possibly can, and you have a massive multiple of your money, potentially 2 to 3 years in.
Guess who got rich during the last gold rush? It was the people selling the picks and shovels. Hey everyone, welcome back to another episode of AWM Insights. It's your host, Justin Dyer, Chief Investment Officer here at AWM Capital, joined as always by Mena, Hanna, my co-host and portfolio manager here at AWM Capital. Today we're gonna go a little bit deeper on the AI topic. It's ever present, potentially ever growing, maybe even a bubble, who knows? We'll kind of talk through that a little bit today. But yeah, just how, specifically how the 100-year family should really think about all the hype, all the headlines that are surrounding this general topic at the moment. So yeah, without further ado, let's jump into it. Mena, as we always do, try to take a step back, kind of level set, align listeners, ourselves with this general topic. The general topic we're jumping into today, artificial intelligence, data centers as well are part of that, right? It can extend, potentially, right? People are saying to every part of the economy. We're not going to go that deep and that granular today, but specifically, we really want to help the 100-year family understand what's going on, but maybe even more importantly, how to think about investing around this topic.
Yeah, AI and data centers are obviously super intertwined. You need a lot of, call it just capacity, computing capacity to run these models, for these models to learn, train, meet the needs of their users today. So you have these massive plants that consume tons of energy, they consume tons of chips, they take up a decent amount of space as well, and they consume a lot of water. So a lot of consumption that goes on to really just work these machines properly, and for AI companies to be able to monetize their models and continue to improve and enhance them. Now, that space has been super, super hot recently, obviously, because everyone thinks that there's going to be a ton more AI usage. These models and these, call it warehouses, are just going to be more in demand. Companies, Anthropic leases out a lot of computing space. Companies like Anthropic are going to pay top dollar, obviously, to have access. And as more and more businesses and people use AI, there's just going to be more demand, and any supply there is going to be bid up. So what we're seeing is these data centers get priced at pretty crazy valuations. People are making plans to build them in a whole host of new areas, but it's not just a foolproof, call it, strategy. There's a lot of risk here. There's the water rights risk. There's the energy risk. There are a lot of risks, and you're actually also seeing companies like OpenAI that have made commitments to open a lot of new data centers and partner with a lot of people, kind of step back and say, hey, yeah, we want to grow, but the commitments that we've already made to you guys, we probably can't fulfill them for a whole host of reasons. So yeah, lot going on there.
And even, upstream from the data center hype and valuations, the obviously, like, artificial intelligence is making headlines all over the place, but there's hype and crazy valuations on that side of the marketplace, let's call it. And kind of like I alluded to, there's belief that this is going to have lasting impacts throughout the entire world, every kind of walk of life potentially. Now, that's a pretty bold statement. And anytime you get into a situation where it's like, hey, this time is different, I would say, number one, tread lightly, tread cautiously. But at the same point in time, anytime that has happened, there's been this incredible technology where there's been an interesting financing environment. Maybe at points that's been an outright bubble, which we really only know about kind of in hindsight. Those technologies are actually good, or those, you could argue those bubbles in a way are actually good for humanity long term, right? Because it's investing in this newfound technology. And if it weren't for the bubble actually happening and on this influx of money and investment going into these companies or data centers, we wouldn't have the technology down the road. Now, that's interesting, and that's kind of like philosophical and, maybe a student of history type mindset to have with this. And we want to talk about the 100-year family. We want to unpack, how does the 100-year family, how should the 100-year family think about this? Is this something we want to invest in because everyone's talking about it? Is there any aspect of this that we want to be involved in from the 100-year, supporting the 100-year family priority standpoint?
Yeah, and I think you have to be thoughtful about how you access these businesses and how you access this trend in general. We've seen a lot of big players just spin up large pools of capital and throw crazy money at developing these data centers. That is the bubble mentality that typically does not work out well. We've seen some cracks form. I kind of highlighted the OpenAI thing, but that's hopefully all we're going to see on that end, at least for the time being. Another example of sort of crazy hype, Allbirds. Allbirds was a shoe company that sold its
data center.
Yeah, it was a shoe company that sold its shoe processing company and then pivoted to be essentially it was using its space to help these companies and sell computing power and sell space for companies to actually establish computing power. It was up 800% in one trading day. And ever since then, it's down 80-ish%. So you saw a massive spike up. Now it's still worth twice as much as it was as a shoe company. So
that's interesting.
There's a little bit of froth still, but you can see there are massive moves. And if you would have invested in Allbirds, and it's a tiny, tiny part of the market, but invested in Allbirds through all of the hype and speculation when it was up 800%, you'd have lost a lot of money on the way down.
Yeah, I want to both acknowledge that, and anytime you see pivots like that, you got to scratch your head. And I think you've used this term in the past, that it just doesn't really quite make sense from a financial physics standpoint. There's got to be some logic underpinning the broader financial modeling that you apply to long-term investing. And we're seeing some detachment from that quote unquote reality. And that always gives you some pause. However, I do want to make sure we talk about venture capital and kind of how we think about venture capital. Because at the end of the day, these companies, not the data center side really, that's the real estate play, and we can talk about that a little bit potentially, but the Anthropics, OpenAIs, you pick your name brand AI company today, they started out as venture-backed companies. And so how do we think about that, right? Where do we actually want exposure when we're investing in the world of venture capital? Is it that company at the current valuations because it's quote unquote private and still technically venture capital because of who backed it? Or is there some other playbook we deploy? Yeah,
ideally you invest, in this case, it's an 800% markup. Ideally you invest before the markup happens. In Anthropic's case, you invest as early as you possibly can, and you have seed Series A exposure, and you get to ride that wave up, and you have a massive, massive multiple of your money, potentially 2 to 3 years in. So you want to invest early. You want to invest in also a basket of companies because
you don't know. Yeah, right.
Yeah, you don't know who Anthropic's going to be, and you don't know, the company that we don't know because it went to zero. So you have to diversify. You also have to get in at the right valuation and the right price. We're seeing this. A lot of people are buying shares of Anthropic on the open market. They're either paying crazy fees like 10 to 20% on entry, or they're paying a 20 to 40% platform fee which we were just talking about before this call, that works out if Anthropic absolutely crushes it. But if they stagnate in terms of growth, you're really starting at 60 cents and hoping that it goes up. That's if I invest $1, I don't want 60 cents to actually go to my investment. So when you really think about it, you have to probably invest early. I shouldn't say probably, you do want to invest early. You want to invest without fees, and you need to diversify because you have no idea what company is going to pop and what company won't.
And we need to diversify not only across companies, but across company types. We want exposure to AI. It is an incredible technology. It's a little hypey right now. It depends on where you are. I think it's still very interesting at the earliest stages. A lot of people are doing very interesting things, but that's what I'm getting at. We want to diversify there. We don't just want to be in the big hyperscalers, as they call it. Hyperscalers are the Anthropics, OpenAIs, right? These are the core models. There are interesting tools and technologies being built on top of those. There are also let's call it the picks and shovels type companies that maybe are building or developing the technology that can support the data centers, whereas the data centers are like the gold rush or the gold mine, right? People are chasing or want to figure out where the next gold mine is. Well, guess who got rich during the last gold rush? It was the people selling the picks and shovels. And so we're thoughtful around it in that sense as well. I think that's also super, super important to remember.
Yeah, and on that end, there are going to be a lot of boring businesses that actually do super well. We have a few examples in our portfolio of boring businesses, just a couple to highlight. Companies that create the chemicals that go into the coolant that actually cools down these data centers. That's a pretty boring business. It's a chemicals business, but it's a business that's actually doing extremely well because of how much coolant these data centers actually need. They actually use on average, data centers use 1 to 5 million gallons of water a day, which is crazy. Other side of that too, and we're just talking about water here, there's a lot of energy applications and other applications in general, but companies that treat and process the water after these data centers are done with them and recycle it. Those are going to be boring businesses that do extremely well because of general AI. And if you don't diversify, and if you're just looking at, call it the large language models and just the big players and concentrating there and avoiding the rest of the market, then you're not really investing like a diversified professional. You're underexposed, and typically that means your risk is probably a lot higher than you think it is.
Let's wrap by talking about kind of the other side of the coin here, the public market side of the coin in a way. These companies are not public yet, but there's plenty of discussion about them going public. We know SpaceX, which is what now, SpaceX AI. I think they just changed the name to that. They're going through the process. Anthropic's supposed to go public. At least rumors are saying that as well. So again, kind of summarizing where we stand, right? We've talked about the private market application, how we think about the world of venture capital. We want to be very early. We don't really want, just because these companies are still private and called venture-backed companies, at these valuations with this hype, they're effectively trading like public companies, but in a way even worse than public companies because there's access constraints, and so prices are getting bid up, and there's all sorts of convoluted terms and very much buyer beware type situations going on. But let's extend that to the public side of things. Kind of just going through the exercise of them going public. How do we think about that? Let's remind listeners, 100-year family, is this something where, these companies are becoming public, we want to put a bunch of money into them and be overly concentrated? Or what's the playbook on the public market so we're really supporting the priorities that are most important to that 100-year family?
Yeah, and when these companies do go public, they're reconstituted into an index. Typically at this size, they're going to be entering the index. You have to be very thoughtful about how you actually access these companies after IPO. What we typically see is a massive rush in terms of investors rushing into these companies. But for the most part, you actually can't, if you're a private investor in this space, after an IPO, you can't sell the shares for 6 months. So you have an initial rush of public investors trying to buy up the shares and the market float, the number of shares that have hit the market. And then you have sort of a lull phase until everyone's actually able to sell them in 6 months. There's a lot of movement and activity that happens there. The data actually supports kind of avoiding these companies high level and not over concentrating in them, because when that 6 month node comes, there's a lot of people running for the door, and it goes back to that theater example that we talked about. If there's a very narrow exit, you know what's going to happen. Now, these are all happening in different ways, but you really have to be thoughtful in terms of how you incorporate new IPOs, new companies. We kind of saw this with SpaceX Tesla, getting added to the S&P 500. You have to be thoughtful in how you add these positions, and index funds have been notorious for not doing that well. So needs to be thoughtful, needs to be diligent. You can't just rush in and buy Anthropic the second that it IPOs, because it's more complicated than that.
Yeah, and right, diversification is still your friend very much on the public markets, if even more so. There's a larger universe that you can easily get access to. There's a great old adage, the dosage makes the poison. It's very true in investing. You never want to be overly concentrated in any one company, in any one type of investment, because it can really damage your 100-year family and what's most important to you, and you all meeting your priorities, right? I think it's always super important to bring it back to that. We'll wrap there. So hopefully interesting conversation, kind of wrapping a current event, current topic that's at least very much on the top of our heads, our minds, around AI, the valuations we're seeing there, what that means for venture capital investing. As a reminder, we very much like the earliest stages of venture capital. You can get really good diversification across quite a few companies, and hope you're increasing the odds of capturing these name brands that are not a name brand today, but will be in 3, 5, 10 years down the road. And also this idea of the picks and shovels approach, right? There's going to be, to Mena's point, boring companies built out of this interesting cycle, which we don't know exactly when it will end, but it certainly is an interesting cycle we're in right now. And then all the way to the idea of concentration. You don't want too much concentration in any one of the public names when and if these companies actually do go public. We just know, in order to have the confidence to meet your priorities, to build that 100-year family, that is not a recipe for long-term success. So again, hopefully this conversation was interesting and worthwhile to you all. Definitely text us questions.
626-862-0355.
We always appreciate you listening. And until next time, own your wealth, make an impact, and always be a pro.